Investors and traders, welcome to the channel Market Chart Pattern. Today is 25th of February 2024. I hope everyone is having a great weekend. This is the weekly review for the key US markets. We will be taking a look at the bond market through the eyes of the bond futures. We'll take a look at the long bond future chart. We'll take a look at the US 10-year Treasury note. And then we will take a look at the US dollar, some key currency pairs such as US versus Japanese yen, euro versus the US dollar. We will briefly take a look at the gold market, and then we will dig deep into the US stock market indices such as the S&P 500 cash index, the futures, ES, NQ, RTY. And we will also take a look at our timing model as we have a key date coming up next Tuesday. And as always, this video is for educational purposes only and is not a financial advice. What you see here in this little window, these are our weekly price levels that we were watching for the past week. So we'll just quickly go over through these as well when we'll get to this section for the US stock indices. And if you will stick around till the end of the video, then I will also give out the price levels to watch for per the standard deviation levels for next trading week. So starting from 26th of February 2024. And I will also put them in the description so that you'll be able to take a look at those as well. So with that, we'll move forward, and I will just move into the this really quickly into Dowjones Industrial Average Cash chart, moving down to the daily chart. Here we go. And what we are looking at, this is the daily chart of Dowjones Industrial Average Cash Index, and here we have been watching our cycles, the timing cycles, and we have a key date coming up per this model, and that date comes around 27th of February 2024. So we'll have to wait and see what the price action will be like when we get even closer to that date. And the way the pricing on the time axis works is we have to give it plus minus 2 to 3 trading days on either side. So sometimes the timing date or the cycle, high or low, depending upon which direction we're looking at, could come 2 to 3 trading days before the key date or 2 to 3 trading days after the key date. And if that date has passed and what we were expecting does not take place, this means that usually there is another bigger cycle which is actually dominating, and time is more elusive anyway. So we'll be waiting to watch and see how the market is going to behave in terms of its price action around 27th of February 2024, which is next Tuesday. So for now, we just want to keep that in mind. And what is this date? This date is basically a Fibonacci external extension, and it's very similar to the one-to-one price projection that we do, which we like to call ABCD, but it's being done on the time axis. And here it had a good record where it picked up a bottom. It wasn't 100% exact bottom, as I mentioned that sometimes the cycles come a few days early or late, and that gives us a confidence that we should actually also be watching for its external extension or external retracement of 1.382 as well when we get there next Tuesday, 27th of February. And also another cycle that has been operating in this market is the 54 trading day cycle, which is a low to low cycle. So in this video, I'm not going to go into the details, but there are videos available on the channel done in the last couple of months where I describe in detail what the low to low cycle is, just in the essence that the key low to low. So if we measure this low and this low, the harmonic mean is coming around 54 trading days, roughly speaking. Sometimes these cycles expand, sometimes these contract, they could contract by half, or they could extend by a half as well. So with that, key date will come around here. This is gonna be the 54 trading day low to low cycle coming around 4th of April 2024, and we will have another timing coming in around 2nd of April 2024 as well, and that's going to be per our Fibonacci time extension model. So we'll have a confluence of two things coming together on the time axis. And as you know, the subscribers who have been following our channel, then whenever we have a confluence of two or more price patterns or Fibonacci ratios coming together, it's always something we pay very close attention to. So 2nd of April to 4th of April is another key date. I believe personally that this date of 2nd of April 2024 to 4th of April 2024 is actually may have more prominence than the 27th of February one, because we have a confluence of two things coming together. So we'll have to wait and watch for the price action for around both of these key dates. So with that, let's move into our markets. Let's take a look at the long bond futures chart. So this is the long bond futures, and what we were last week when we did the weekend review, we were really looking for a key one-to-one price projection pattern ABCD coming around here. So let me actually move to the weekly chart here, and what we have seen is last week this ABCD, which I've drawn on the daily chart here, it also coincided with the 20-week moving average, and after falling for 1, 2, 3, around the 4th week, the market did find buyers come in. So it's a really important support level for the long bond futures. So here we go. So last Friday the bonds rallied quite a bit, and this is something which is actually encouraging to see. And if we were just to draw a micro trend line, so if we just draw the trend line from the body of this to the tops of these candles, what we can also see is a breakout taking place around here. What we'll be now watching for is the retracement, this 38.2% Fibonacci retracement, which comes around 120 level. That's going to be a pretty interesting and important level to watch. Should the market is able to get above this, then the chances are that we might in fact be looking at an ABCD to the upside, which could see the market move much higher, which indicates lower yields. Let's take a look at ZN. This is the 10-year Treasury note market. Here we have something very similar, but a little bit different pattern because we don't have this ABCD. What we have is an extension of ABCD. So if we were to take this high to this low and project it from this top right here, so this one actually fell between the very close to 1.618 extension of it. So the low came in around 109, 109.09, and 109 was the 1.618. We also have this 50% retracement of this entire swing low to high coming around here as well. So this is the 10-year Treasury note, which is a shorter duration than the longer term long bond futures, which is 30-year. And what it means is that actually the interest rate structure in terms of the yields, the 30-year did not go down as much compared to the shorter end side of the curve. So again, watching this last Friday, encouraging price action, price fair amount of movement in the Treasury note market, which means the yields actually moving lower. Let's also try to take a look at the 2-year note as well. So let's take this one. This is the yield. So this one is a little bit different chart in the sense on the y-axis we have the yields, we don't have the prices. And here what we can see is shorter end 2-year, the market has actually moving higher in terms of yield, so the prices have been moving lower. And last Friday it reached for a potential double top formation. It's not a confirmed double top, but it's very close to this double top, this top which came in around 11th of December 2023. So 4.75 appears to be a key level. Let's see in terms of the retracement, how much is this retracement about? So it might be 50%, little above 50%, but actually close at the 50% level. So this is what the yields have done, and there's a potential that around here it might be a double top, which means the yields could fall, which would be good, and it should also then support if the yields are falling, especially on the shorter end of the curve. It should generally be supportive of the risk assets. All right, so now let's take a look at the US dollar. So this is the daily chart of the US dollar, and here what we were watching for was, when we did the last video we covered it, the market had actually closed a little bit below around here, sorry, excuse me, this is where the market was. So last time when we did it was around here, yeah. So this 61.8% retracement was kind of, you know, providing us with some resistance, and we had a really strong move on 13th of February 2024, but the market retraced all of that, and now we have this channel formation. And the interesting thing is, I'm going to show this to you on the weekly chart because it's easier to see it on the weekly chart. Here what we are seeing is basically a retracement right into, let me actually try it. We can remove this one and put in, so it retraced exactly to the 38.2% retracement. So here one of the key things that I would like to bring to your attention is that this market, which is US dollar, it has been going up for 1, 2, well, this is an inside bar, but still part of this uptrend. So we can count it 1, 2, 3, 4, 5, 6, 7 consecutive bullish bars, with the exception of this one, which is internal but in the upward movement structure. So I'm counting it, and this is the first bar that we have seen which has closed bearish, and it in fact retraced 38.2%. Now in my opinion, this is really key. If the market begins to close below, especially on the weekly basis, the 38.2% retracement, then the possibility increases that what we might actually be looking at is a pattern like this, where this might have been a top coming in right at the 61.8% retracement, and the market actually be trying to move lower, maybe go and move lower and test this breakout area, maybe even a little bit lower. And if the market is able to take out 99 with a convincing in a 2 consecutive weekly basis, in my opinion, then we could be looking at a much bigger pattern and a lot of weakness in the US dollar. On the other side, on the flip side, if this 38.2% retracement is held, then this pattern that we had been actually watching for, drawn in purple line, in fact could see the US dollar go as high as 108.75. So that's going to be quite a lot of strength in the US dollar. So again, this 38.2% retracement, 103 level roughly speaking, is really important, and what we'll be watching for is whether the market closes below this. If it does, then it'll be breaking below this channel, and if it is able to keep this as a support level, then that's going to be a pivot in my opinion, and we could see the price move higher. On the daily chart, we'll have the 78.6% retracement coming on 105.55, and on the weekly chart we have actually these highs getting challenged and maybe move a little bit higher. Now let's take a look at the Euro USD. So this is a little well, it's not a perfect mirror image of the dollar index, but In the dollar index, we have about 51% composition is actually the euro currency. And what we have seen is last Thursday, 22nd of February, we saw the market move higher right to the 38.2% retracement. So what we have seen on the dollar index is this was support, here was resistance for the Euro USD currency pair, and there's also this potential 3 drives to a top pattern as well, the one which is drawn in this purple shaded area. So we are watching this. The market might actually go sideways for even few more trading days. So it was an inside bar, this is the mother bar, and then if it is able to break below this mother bar, the chances for this to move lower will increase, and which means a continued strength in the US dollar. The really interesting currency pair to watch is the Japanese yen versus the US dollar. So the Japanese yen has actually been much weaker, or the US dollar has actually been much stronger against the Japanese yen. And what we have seen is that ever since it found support from the 78.6% retracement, after breaking out of this challenge to the downside, it actually made a resumption of the uptrend and moving higher, and now it's really challenging this old channel highs around here. It's also above a 78.6% retracement, and there's a potential it might actually go and try to challenge these double top highs one more time. However, what we look at is that 13th of February 2024 was a really bullish bar, and there is a chance that this might actually be an exhaustion bar, much like there was an exhaustion bar here on 31st of October 2023. And after that, what we have seen is the market actually a failure for a follow through from a price action perspective, and the market coming back and testing the bottom of this breakout failed breakout bullish bar, and then for a few more trading days, and it went and tried to take this out. It wasn't successful, and then there was a bear trend, which was in fact a major trend reversal, and it just went lower to right to the 78.6% retracement. So in fact, this market on a really longer term chart, in fact, might be just a range bound, but a pretty big range. And on a daily chart, it's just going to retrace pretty much to this double top formation here. And what we are seeing now is just the market going sideways. So it's been in a range formation since 14th of February, and moving into 23rd of February, we just saw a candle which is a doji formation, which means that it was just a fight between the bulls and the bears throughout the day, trading day, and both of the bulls and the bears then decided to settle on a fair price, which was a perfect kind of a balancing formation. Let's see if how was its close. Open 150.52, and in fact it just closed a little bit bearish, so the bears seems to have won by a very small margin. So we're just watching this because it's just gone sideways after such a bullish bar. The chances would have been that if this market was so bullish, then there would be a follow through, but in fact what has ensued is a trading range, and it might just be testing the top of this range, and the chances will increase that it might in fact pull back a little bit more. Let's take a look at the British pound. So we are taking a look at the daily chart of the cable. The really interesting thing about the cable is it's stuck in a range of support coming in from this swing low to this high at 38.2%, and the resistance coming in from this swing high to this low at the 61.8% retracement level. And the chances are it might be just forming in this arc kind of a pattern where the market actually might be going through some sort of distribution perhaps, and it will only come into effect if this low of 125, roughly speaking, is taken out to the downside. To the upside, there's also a possibility it might just be a holding kind of a pattern where there's a fair amount of accumulation coming in, and if the price is able to break above 128 roughly, then the resumption of the uptrend will begin. So we are just waiting and watching for this one. Now let's take a look at the gold market. So this is the gold market, and here just it is trading sideways, just not really going much anywhere. But what is really interesting is that with all that strength that came in the US dollar, this market is holding pretty well. So that's positive for this market. And just sideways trading range. And let's just see what sort of retracement we got. I believe it retraced to about 61.8% retracement. Yeah, there we go. So we had an exact 61.8% retracement. The market still closed bullish. However, we have got these wicks on the top and the bottom. So not a fantastic looking bar. It's very similar to a bar like this. So what we really need is a follow through for the price to move higher. And if we get an inside bar or we get a bearish bar just like this, chances increase for the market to in fact pull back, maybe come down and test this 1983 level or 1988 level. With that, let's just go and take a look at the US stock indices. So this is the cash index. I'm going to move to the weekly chart. This is the S&P 500 cash index. One thing I want to reiterate is look at this really strong and nice trend line. I'm going to actually extend this a little bit here. That has been in place since the COVID lows of 2020, March 2020, and we have seen every time the market comes and tests this 1 time, 2 times, 3 times, the market moves higher. So it's a really important trend line that we should be watching. Now, one of the key things is that the market, we were watching for certain levels in the market. The market actually met and exceeded a lot of those levels, such as this ABCD, which was completing around 4,900. We also had an expansion of 1.618 coming around 49.20 roughly. Market actually went above that. So in fact, what is happening is this ABCD is actually extending by 1.272, and this is where the market went exactly to this level. And then there was a little bit of selling that came in on the daily chart. I'll just move down the daily chart as well. So that's why I have actually made this one a little bit extended. Now what happens is that this when there are really strong markets, so this 30th of October low, it was a pretty strong low in the marketplace last year, and then we could see a really strong move which could in fact extend. So there could be some bigger cycles which are actually in fact moving the prices higher, so that's good. And then we have this 1.272 expansion coming around 51.88. The market went as high as 51.15 roughly speaking. So there is perhaps some area of further move as well. There is a possibility, but with the timing coming in that we looked at the Dow Jones cash index chart and also the price action which took place last Friday right here, where we had a bearish close. I think there might be a possibility that there is a chance that this market is actually now beginning to change its phase, where it was really bullish from last October lows to maybe morphing into a bit of a trending range. Now on the weekly chart, we don't see the weekly bearish candle at all, but in the daily chart, what I want to point out is if we just look at this C to D swing, I should move the what I should do is just move this D around here. Well, it has reached that, so I'm going to remove the question mark as well. We can really count on the number of occasions where we have seen bearish price action. So what we see is just one big day and then a reversal the very next day, which is a really good strong sign that there's a lot of strength in the marketplace. Here the market goes sideways or trading range, and then it breaks out of it. Another really strong bearish close. The market forms an inside bar, breaks above it, so this is nullified. Then towards the end of the year, and when we had the new year, beginning of the new year, we have seen certain days where the actually market moved lower. Then a really 8th of January is when we had a really strong bar, then a few days of sideways action to downward around here, and market really closed higher here. Then another really bullish, the bearish bar negated the very next day. And here now, ever since 12th of February, we are seeing a strong move lower, then a move higher towards the top range of this high around here, then a couple of days which are bearish, and then a really strong move. So there's a chance that this market might actually now be might not accelerate as quickly as it has been accelerating to the upside, and maybe there's a chance the market actually begin to move into a more sideways to up momentum. That's possible. So the reason is that this close, which was a bearish close last Friday, and in this really massive bullish run, where the market has been this much extended, there are likely to be profit takers, which might be actually taking their profits. And if we begin to see a few more trading days where we have some bearish closes, for example, but sideways market, this means other profit takers could join as well, and maybe some of the bears, and there have been plenty of bears. You just look at the YouTube, that might join the party as well, which could in fact see a trading range ensue, maybe even a little bit push lower to the downside is also possible. And also the market has reached some of the extended price targets that we had. We do have another higher one as well, 51.88, so possibility remains for that to be reached as well. So but we'll be watching the price action really carefully. Going back to the weekly chart quickly here, so on the weekly chart, all you see in this really strong extended move, one bearish week, another two bearish weeks, and all these weeks, which are 1 2 3 4 5 6 7 8 9 10 11 12 13 14 15 16 17 weeks of this rally, and only two bearish week closes, which was, this one is a pretty bearish close but reversed, and this one was more like a doji, but there was no confirmation. So there's a chance maybe we might have some profit taking place. Now let's take a look at the NQs. Let's take a look at the ES, which is the S&P 500 E-mini futures. Very similar to the cash index, but the key difference is that this is what we were watching for, the 1.272, and the market is pretty close to 51.44. So this was our target, and we are very close to achieving the exact target. There is a chance early next week we might in fact be able to hit the exact level. So this is what we are watching in the S&P 500. And now let's take a look at the NQs. So this is the weekly chart of the NQs. Now, one key difference that I would like to point out for the NASDAQ 100 futures and the ES E-mini is that ES E-mini had been stronger last week, especially last Friday. Fair amount of movement coming into NASDAQ 100 stocks, and the S&P 500 is actually stronger. Now this could be because of some inflation data that came in. It could be because of some profit taking. I do not know exactly, but this market is a little bit weaker compared to the S&P 500 broader market. Here, the level that we had been watching for is around 18,570. Now for the NASDAQ, moving about 200, 300, 400 points is not that great of a deal. It could do that, so it's still possible for it to reach. But last Friday's candle, I would have liked it to be a little bit stronger, because we do have a wick at the top, but it's not really an extended wick, but still it's not as small as the wicks of 5th of February candle, which is something I would have liked to see. So again, moving down to the daily chart, here we go. Here what we see is a bearish close last Friday, much like what we have seen in the S&P 500. Now one of the things is that it's not a confirmed double top, but the market actually tried to take out the highs of the 12th of February 2024, but there were sellers above there who sold into this, and profit taking, for example, is a possibility. So here the chances are that we are actually beginning to move or transition into a trading range, maybe a little bit to the upside as well, so sideways to upside, meeting that target which we have on the weekly chart. So we'll have to wait and see, but the chances are increasing that the market might actually be transitioning into a trading range possibly, and this is the trend line that we can draw around here. We can actually also draw it like this. Here we go, like this. So we'll be watching this trend line really carefully. Now let's take a look at the Dow Jones Industrials through the eyes of the its futures chart. This is the daily chart here, and what we see on the daily chart is this market, in fact, last Friday closed a little bullish. However, not a very fantastic looking candle, because you can see there is a fair amount of wick at the top. So which means that at one stage the market was around 39,343, and then it lost about 150, a couple of hundred points by the close of it. So profit taking there as well, in my opinion. And on the weekly chart, what we can see is yeah, there we go, market closing above last week's high. So this kind of sideways trading range action negated. But yeah, so again, VIX at the top, at the bottom. Weekly on the daily chart, we see some profit taking perhaps. So again, more like a trading range might ensue next week possibility. Finally, last but not least, a Russell 2000 as a weekly chart. This one is stuck in a range. Good thing is finding a good amount of support at 1922, which is 38.2% retracement. Now this is a trading range behavior on the weekly chart. It tried to go and tackle these highs, but this is where it's stuck. Looks like there are sellers up there, and all those bulls that have been buying around at the bottom, taking perhaps profits around here. There might be some sellers coming in because this is a lower high compared to this high, so that possibility is there. And then we have an inside bar formation. But the good thing is that as long as it remains above 1922 on closing basis, the chances are it might actually remain at least stuck in this trading range, or might even try to tackle these highs of around 2095 one more time. So thank you very much for watching the video. Apologies that the video took fairly long. It's about half an hour long. I also wanted to do this video because next week I'm traveling. I will be in a different time zone, so I'm not sure how frequently I will be able to do the videos. So I just wanted to do a longer video to cover a lot of things, and we have covered a lot of things in this weekend review. And the last thing that I also want to just show you guys around here, these are our standard deviation levels for next week. We are looking for a movement of, on the weekly basis for the entire week, about 97 points in the S&P 500. So I have made an error. The NQ figure is wrong, so apologies for that. I'll try to correct it. And then 740, 750 points in the Dow Jones futures, and about 30, we can say roughly about 40 points in the Russell 2000 RTY. And then if we add these range to last Friday's close, plus and minus, we get plus minus standard deviation levels. And to get the plus minus 2 standard deviation levels, we need to multiply this with 2 and subtract or add to the last week's Friday's closing price point. So thank you very much for watching the video. Good luck and good trading, and speak soon.